So still on APV, it has advantages and as well as disadvantages. And that's what I've summarized in this table for you. If you look at the two advantages, the first one is the fact that this particular method can be used to evaluate any financing structure. So you don't have to recalculate WACC the way you used to do it under WACC. But this does not use WACC because financing structure is why we are calculating WACC, weighted average cost of capital. We have to weight under the WACC, we have to weight the debt and equity based on the proportion. But here we don't have to do all of that. So whether it is 50-50, 70-30, 80-20, we don't care. It doesn't matter for APV method. So that saves us time, and that's why we also consider it to be more straightforward than the risk adjusted WACC. Like if you are playing a different industry or you are having different financial structure, you have to start recalculating beta, recalculating cost of equity, recalculating WACC. For this method, you don't have to do that. That is for risk adjusted WACC, and that's why this is pretty more straightforward, because for this one we are separating the equity investment part from the financing effect. But that doesn't mean that it's all perfect. It still has its own disadvantages, and the bulk of its disadvantages is coming from the fact that it follows M&M principles. And in that case, it ignores the fact that there's a bankruptcy risk, because under M&M, you want to take as much debt as you can. So take, for instance, if your debt capacity is, let's say debt capacity is 400 million as a result of a project. Please listen to this carefully. So sometimes what I'm saying here is a company does not have a way to get loan. However, because they've decided to go into a new project, the bank has evaluated the project, realized that this project is really good, the cash flow is fantastic, and because of that, the company will be able to borrow $400 million. Even if the company decides to use 200 million as debt to finance the project, please, your interest and tax on interest benefit must be based on 400, because the assumption is always that the company will always take all the debt that you can take. So your interest benefit must be based on debt capacity. Please take note. Yeah, so even if they use 200 million on the project, the assumption is that they will still collect 400 and use 200 on another project or another activities in the company. Yeah, you might be saying, but they are not using it on the project. Doesn't matter. The relevant benefit is coming from the project. So the benefit has to do the net MPV of the project. Please take note, because this is a trick that you can find in a question. Yeah, so they assume that you just always be taking debt as you can. But the more you take debt, the more risk you are getting into in terms of getting bankrupt, because it gets to a point that your interest expense might be so much that you might run into trouble and go bankrupt. So, but they ignore that. They don't care about that. They also ignore tax exhaustion, just like M&M. They don't realize that it gets to a point that a company might not be profitable, and in that case, the tax benefit doesn't make sense again, because there is no profit to deduct it from. And the last one is the fact that they believe debt is perpetual, that you always have debt. And what this means is that the tax benefit will always be overstated. Because instead of understanding that debt is tenured, they believe that you will always have debt. So those are the disadvantages of APV method. The last part I'm going to touch on quickly on this video is international CAPM. To wrap up our financing part, international CAPM. Extremely important to know this, not from calculation really, but understand it very well, because this is different. It's an advancement on your traditional CAPM that you know. It's not too different, but it's just a little advanced. Because your traditional CAPM that you know, this one focuses on domestic market. So this is when you are trying to invest or do a project in your domestic market. You want to evaluate that project, but the project is not foreign, it's domestic market. In that case, you are used to calculating the expected return on that project to be equal to risk-free rate plus the beta equity of the project minus market risk premium. Times market risk premium, which is market return minus the risk-free rate. This is what you are used to. But the international CAPM is saying that sometimes companies do investment on the international market, or the company is owned by foreign investors. Either way, that project has exposure on international space. So there's an international exposure. And in that case, what international CAPM is saying is that you cannot calculate cost of equity based on your traditional CAPM. Because if a project is exposed to international exposure, then there is a political risk that is involved. There is even interest rate that will be different. And likewise, even there is a currency risk because you are leaving your domestic space. And when you look at all of this, they're saying foreign investments are exposed to global risk. And this has to be considered in the CAPM formula. Well, how do you go about that? So the same formula is being used, but different interpretation. So the expected return still remains the risk-free return plus beta, now relative to what? Portfolio, global portfolio, into bracket return from global portfolio minus risk-free rate. So this is what international CAPM is saying. And they're saying this because they believe that if you are operating in the international space and you have this exposure, you can diversify them. Believe that this can be diversified. So which means we should not compensate any investor for being exposed to any of these risks. We shouldn't. That is what the global market is talking about. Because in the global market, you are not just in international market, but also you are operating in what is called an integrated market. You have access to fund. Yeah, in integrated market, movement of fund is easy. Movement of fund is easy. And if movement of fund is easy, what does it mean for cost of capital? It means that your cost of capital will be quite cheaper because you can borrow anywhere. And there will be competition for sure because money is available for everybody. There will be competition. And if that is the case, then your return on equity for international CAPM, you will expect it to be lower compared to when you use your traditional CAPM. So which means when you do investment appraisal that has foreign investors or in international space and you wrongly use domestic CAPM to do that appraisal, the cost of equity will be high and your NPV will be low. And in that case, you might end up making wrong decision and saying the investment is not good. Because these are the kind of discussion you will be expected to make. You might be given a question that you have been asked to calculate using the traditional CAPM, and they're asking you, you should explain or discuss one director's opinion of whether international CAPM should have been used. Even if you are not doing any calculation, you should be able to explain it to say that, well, if this investment is in international space or let's say is being funded by foreign investors, the international CAPM would have given a lower cost of equity, which means the NPV would have been higher, and that would have increased the NPV maybe from negative to positive, making them to change the decision of whether they should do it or not. Right. So please take note of that. Another point I'm going to note here for you is to understand that a risk that used to be systematic when you are using this domestic CAPM, by the time you get to international space, that risk becomes diversifiable. And that also makes the risk exposure to be lower under international CAPM because the remaining risk that you are left with to compensate the investors will be lower because almost all the other risks that you think are big enough, they are systematic risks in a local market. By the time you bring it to an integrated market that is global, Some of them become diversifiable and you should not compensate an investor for it. And because of that, cost of equity also can be lower. So please take note and you should be able to explain this.